Good morning and welcome to the new episode of Dr. Lamba's Awakening Call. Recession is an important aspect of any economic activity because any economic activity is cyclical. It's always there, the bears and the bulls in the stock market. The ups and downs in the economy are normal because of the societal factors. Mostly people think it's economy. No. If there's a war, all natural factors, if there's a drought, there's a tsunami, there's a flood, it would impact all activity. Even pandemic, when it spread, caused a lot of unemployment, caused a lot of hardship to the people, and economy did suffer. As a matter of fact, I always say that recessions are like unhappy families. They are painful their own way. But many times they are such a burden that it's difficult to bear them out. And the next recession, which is possible by the end of the next year, will probably bear that out. An economic downturn may be modest, but it would also be long, and the signs of economic weakness are multiplied. Say, the signs show what's going to happen. As they say, you get up in the morning, if it's cloudy, you think it's likely to be bad. And that's what's going to happen. As a matter of fact, if we see the next economic recession, the downturn, as I said, it would be long. It would not peter out in a couple of days, a couple of months. If you remember in 2007 to 2009, 2 years, we had experienced a great financial crisis. And the back-to-back downturns were earlier seen in 1980s. When inflation last was this high. And the height of inflation this year is compounded because of the various factors. The attitude to the work has changed. People are resigning their jobs. They are content to be minimalists. And when an attitude of minimalism comes, naturally the consumption will stop. And if the consumption stops, what happens then? Production would automatically suffer. So economy is simply not so far out to whack as it was in those earlier periods. Yes, because the attitudes have changed. At that time, if you remember, it was for a short time in 2020. In December 2007, it was a much longer. And if you remember, November 73, it was still worse. However, let me make it very clear that this economic recession is not going to be global. This is going to be Europe because of the Ukraine war, sanctions on Russia, resulting in Russia's cutting out gas to Europe. Secondly, North America. It would suffer badly. USA will suffer maximum. Already it's suffering. Recession is already there. I posted a couple of days back. How the stocks are likely to nose down. Now look on the other hand, Indian stocks are maintaining their high level. They are bullish. So these things are happening. Now while the recession may be moderate, but as I said, this will be much longer than the 8-month contraction in 1990, 91 to 2001. Those 2 years, it started in 1991, continued to 2001, long period. And that is because this time there is elevated inflation. Result, it would hold the Federal Reserve in USA, and Canada follows that. And Europe, because of the war and other reasons, the Federal reserves and the central bank reserves would not be rushing to reverse that downturn. The only good thing is that it will be not very severe. And if I go by the New York Fed analysts, they see a roughly 2% contraction that begins in the fourth quarter this year, that's in December, November, and continues the whole of the next year. And no matter what shape the pullback takes, you can be sure of one thing: as consumers, as intelligent parts of the society, that there'll be a lot of hurt when it comes in. Since World War II, there have been more than a dozen times recession in this world. And on an average, the economy contracted by 2.5%, unemployment rose by 3.8 percentage points, and corporate profits fell some 15%. And average length every time was 10 months. Even a downturn on the shallower end of the spectrum would likely see hundreds and thousands of the people in North America and in Europe lose their jobs. Hundreds of thousands. And when unemployment goes up, what happens? Then the government has to come in with the social security. That means more taxation or printing more money, return inflation. And that's why Roosevelt was the most sensible president when he came up with a New Deal. Secondly, the stock market would suffer a further fall as the earnings drop. And Joe Biden's already poor poll rating could take another hit. So could that of Justin Trudeau. So could that of Macron. If you have seen, England is already seeing a political tsunami. So when the economy comes down, political leaders also suffer. And that causes social unrest. And this would be sixth or seventh recession for the last decade or so, or 2 decades, and every one of them is different, and every one of them is equally painful. I'm not concerned with the length, I'm concerned with the impact on the people. And look at the signs of the economic weakness, which are multiplying. The personal spending in May for the first time fell down because of inflation. A US manufacturing gauge hit a 2-year low in June. Now, as I said, when USA has bad cold, Canada would have pneumonia. And that's a problem. The latest data shows that mid-year growth forecasts are close to recession. And that's why I say the recession would start having its impact in the last quarter. And the depth and the length of the recession will be determined by how persistent inflation proves to be and how much pain the government is willing to inflict on the economy to bring it down to the level it deems acceptable. You can already see the food prices in Canada, for example, have gone up by 26%. Prices have gone through the roof. So I'm worried by a stop-go scenario, and it is akin to what happened in 70s, where premature release of policy in response to economic weakness was adopted, and that policy eradicated inflation from the system, and that was bad. If inflation is bad, stagflation, which is in Canada today, is still worse. Now what happens in such a strategy sets a stage for an economic decline down the road. and there is a greater inequality. If you remember last year, the economists had given a warning that the Feds in USA were making a big blunder by playing down the inflation threat. And that's a problem, Political leaders enforce such decisions which are not sensible. And what happens is they are not going to pause until the inflation has convincingly come down. That means that the interest hike will be well up in the economic weakness, and it's like prolonging the duration of recession. I know the government is trying to cover it up and camouflage it. For example, the Fed chair argued that there's a risk of recession, but economy is good enough to withstand it. Well, if the risk is there, what is the counter step we are taking? But then, real economists who are not dependent on the government are not convinced. For example, chief economist of Stiff Nicholas, I was talking to him, and he said that a faltering economy is inevitable. The question moved beyond if we are going to see a recession to what depth and duration. So as far as the concept of recession is concerned, there is no doubt. But how deep would it be, how impact it shall be, how long it shall be. And it would be just happened 40 years ago. 4 decades back, the decline in the GDP was driven by the central bank determined to rein in the inflation. And the Fed's favorite inflation gauge is more than triple, is 2% objective. But now it's already, as I said, the wholesale price index has gone up by 4.3%. And there are good reasons to expect that the outcome won't be nearly as bad, that I agree. Because at that time, unemployment soared to double-digit levels. But one thing has to be noted, inflation isn't embedded in the economy. If you remember 1979, after a decade of powerful price pressure, action was still taken. So it won't take nearly a slump for today's prices to come down. But the task today requires half the amount of disinflation. And the government is not doing that. If they take corrective steps even now, that is possible. Now, what's more worrying is that the consumers, banks, and housing markets are in a bad shape. They are not better placed to weather the economic influence. Private sector balance sheets are good. And this is something amazing. For example, we have not seen leverage taken to the extent we saw earlier. But thanks to the hefty government handouts that boosted saving, the household debt obligations amount to 9.5% of disposable income. That's again not a happy sign. If 9.5% of the disposable income goes only to pay off the handout and the debt obligation, that's verging on bankruptcy. And look at the housing market. We discussed this last time. As the mortgage goes up, already the shortage of houses there, but the prices have been going wrong, and now they have come down, crashing. So it's battered by Fed-engineered surge in the mortgage rates. And it too is a better place. Definitely it's better than what happened in 2006. But then, being better than dying is no option. Today, for example, US is about 2 million housing units short of what should require to be. And same is the condition in Canada. If we look at it in a manner to have a overall scenario, we can say that there is a flow to some degree, and there is a sharp depreciation in home prices. And that's again not a very happy sign, because that discourages investment. Any investor would like to invest if the returns are going to be there. But if they're going to be bad, or they're going to be unstable, then the investor would feel shy. And then in the labor market, we are having shortage of labor. The upsurge in resignations, and then the baby boomers are retiring, immigration is lagging, so it makes the companies more cautious about shedding staff in a downturn. The story of the last 2 years, if we see, because we go by what has happened and what's happening, and then deduce from that what's likely to happen. And if I look at the 2 years, the business struggling to find good workers. So you are not going to see the mass layoffs, but the productivity would reduce. So that would make the recession long-lived. And if the federal governments anywhere think that they can ride the economy rescue, then I think they are riding the wrong horse. They are not clear. As a matter of fact, fiscal policy is hamstrung, and it could well turn contradictory. For example, in this election, 22, the by-elections, if they take control of the Congress, and in 24, Trump comes back or any Republican comes back, and in November is going to be crucial. That's why they said the recession is going to be this quarter. Because if they win back the Congress this November, the whole thing would change. Actually, it's an echo of what happened after the financial crisis. Now, what the Republicans would do, they would raise the debt limit send-offs to cut in the government spending. And that again would make a change. And the Democrats do, they are very fond of liberal social spending, which again is not a good thing. So all this is going to create a mess. And we as citizens, we as consumers, we as workers, labor force, executives, we have got to be concerned as common people, because that is going to make life very difficult. And as I said, recession is around the corner. And if the corrective steps are not taken, this could hurt families, individuals, governments, and the countries. And then what happens here in USA and Canada, the first country to suffer. Second would be Europe. But then if these countries suffer, then the countries like China and India would also suffer. Let's not forget that, because these are the major markets. If the markets suffer, what shall you do to produce? So the whole scenario is not a very happy one. Let's hope that some policy decisions can be taken to save the situation. As it is, as I said, the clouds gathering are dark, and I envisage, starting this fourth quarter of the year, things going from bad to worse, continue bad for the next year, and hopefully in 23 they'll start becoming better, or at least stabilizing. Let's hope for the best and be prepared for the worst. Thank you.